Hello and welcome back to the Deep Dive. Today, we're doing something a little bit different. Usually, we spend our time looking for, best practices, how to do things right, secrets to success, all that.
Right.
But today, we're going to learn by looking at a train wreck.
Or maybe a series of very specific, very expensive train wrecks. Sometimes the wreckage is much more instructive than the manual.
Exactly. We are digging into the ACCA Taxation Examiners Report for the UK, specifically the one covering September and December 2025.
And I know what you might be thinking. An exam report. Why do I care?
Right, I'm not an accounting student. But this document is fascinating because it's basically a heat map of where the UK tax system is most dangerous.
That is a perfect way to describe it.
Yeah.
This isn't just a grade sheet, it's a post-mortem. The examiner looks at thousands of papers from people who've studied this stuff. I mean, intensely.
These aren't beginners?
No, not at all. These are people who are literally months away from being qualified professionals. And he points out exactly where they crashed and burned.
So these aren't rookie mistakes.
No, these are the hidden trapdoors in the legislation that catch people out even when they think they know what they're doing.
Okay, so the logic is, if the soon-to-be pros are tripping over these wires in a controlled environment,
then chances are you or even your accountant might be tripping over them in the real world too.
and the stakes are obviously different.
Oh, massively. In an exam, a mistake costs you a few marks. You fail, you resit. In the real world, misinterpreting a deadline or, a definition can cost you thousands.
In penalties, interest, missed reliefs.
Reliefs you can never claim back.
So our mission today is to decode the examiner's mind. We're going to pull out the key failures in corporation tax, capital gains, and VAT to find the insights that actually save money.
Let's do it.
Let's jump right in with the corporate side. There was a scenario in the report involving a company called Beta Ltd.
Right, Beta Ltd. This one highlights a fundamental disconnect between how a business owner thinks about time.
And how the taxman thinks about time.
Exactly. So the setup was that Beta Ltd had a long period of account, 16 months.
Which happens all the time in the real world. A business changes its year-end, maybe to align with a new parent company or just move away from a busy season. So they have one set of accounts covering 16 months.
But for commercial accounting, that's perfectly fine. Shareholders are happy, the bank's happy.
But for corporation tax,
The computer says no. The law is incredibly rigid here. You cannot have an accounting period for tax purposes that is longer than 12 months. It's just impossible.
so you have to take a metaphorical axe to the timeline.
You do. You have to chop it. The rule is you take the first 12 months, and that becomes one distinct period. The remaining 4 months becomes a second, separate period.
Okay, that seems straightforward enough.
And most candidates understood that basic split. The trap, and the examiner really flagged this as a major failure point, is what you do with the expenses inside those periods. Specifically, qualifying charitable donations or QCDs.
This is interesting because normally modern accounting is all about accruals, right? Matching the cost to the period it relates to.
Correct. The accruals concept. But charity is different. The rule for QCDs is brutally archaic. It operates strictly on a paid basis.
Paid basis, you mean like checkbook accounting?
Exactly. It doesn't matter when you promised the money or when you recorded it in your books. It matters strictly when the cash physically left the bank account.
So in the Beta Ltd case, they made donations in, November and March?
Right. And candidates, and I'd bet many real-world businesses, tried to smooth those donations out, prorate them across the 16 months like you would with rent.
Which is wrong.
Completely wrong. If you paid the donation in month 14, it is a deduction only in that second 4-month stub period. You can't just carry it back to the first 12 months because you made more profit there.
That's a massive distinction. You could have a huge profit in the first 12 months and a loss in the final 4.
You absolutely could.
And if you pay the donation in that loss-making period, you might just waste the tax relief entirely.
That's the takeaway. The date on the check determines which tax year it hits. You can't just fix it in the journals later to optimize your tax bill. Once the money's moved, the tax treatment is locked.
That is a real cash-saving insight. Okay, staying with corporate headaches, let's talk VAT. The report highlighted a procedural trap that, honestly, I didn't know existed. It's about who you complain to.
The appeal process, yeah. This is a classic example of how VAT is sort of the odd one out in the UK tax family.
Usually, if I get a penalty for corporation tax or income tax, I write to HMRC, right? There's an internal review. It feels administrative.
Yes, that's the standard direct tax route. But the question in the exam was about a penalty for late VAT registration.
An indirect tax.
An indirect tax. And the examiner pointed out that for certain VAT appeals, you don't just write to the tax officer. The legislation requires you to appeal strictly to the tribunal.
To the tribunal? That sounds like going straight to court.
It basically is. It's a much more formal, legalistic route. And the trap is assuming that friendly internal review process applies to everything. If you sent your letter to the wrong place, you might miss the real deadline.
So VAT really is a different beast.
It is. Different laws, different logic, and a different appeal system.
Yeah.
You just can't apply general tax knowledge to it.
Speaking of VAT logic, the report also mentioned a lot of confusion around the small business schemes.
Yes. The annual accounting scheme versus the flat rate scheme.
Right.
This is a mix-up that comes from the definition of small business. I mean, to a normal person, a small business is just, well, small.
But in tax law, small is a number.
And that number changes drastically depending on which page of the rule book you're on.
Okay, so break it down for us.
So the annual accounting scheme is purely administrative. Instead of 4 VAT returns a year, you just file 1. It cuts down paperwork.
But the threshold for that is?
You can join if your turnover is up to $1.35 million.
Wow, $1.35 million. That's a pretty decent-sized business.
It is. Now contrast that with the flat rate scheme. This is where you don't calculate VAT on every single transaction. You just pay HMRC a fixed percentage of your total turnover. It simplifies the math.
But the entry ticket is different.
Drastically. The threshold for the flat rate scheme is only £150,000.
Oh, I see. So 1.35 million versus 150,000 pounds.
Huge gap. And the candidates were swapping them, applying the £1 million threshold to the flat rate scheme.
So the insight is you can't just think, I'm small.
You have to ask, small enough for what? Because if you try to put a £500,000 business onto the flat rate scheme, you're breaking the law and you're underpaying tax.
Let's pivot away from companies and look at individuals. The report had a section on a character named Beatrice, and Beatrice had a complicated year.
Beatrice is the poster child for the pecking order of tax. We think of our income as one big bucket, but the calculation is actually a series of silos.
She had 2 types of capital gains, didn't she? A business asset and a residential property.
Yes. She qualified for Business Asset Disposal Relief, or BADR. That's the gold standard for entrepreneurs. It taxes your gains at a lovely low 10%.
Fantastic. Everyone wants 10%.
But she also sold a residential property that wasn't her main home, maybe a rental. And because she's a higher rate taxpayer, that gain gets taxed at 24%.
So we have a 10% bucket and a 24% bucket.
Correct. Now, everyone gets an annual exempt amount, an AEA, a tax-free allowance. Let's say it's £3,000. The question is, where do you use it?
Well, logically, I'd use it against the 24% tax. Why waste it on the cheap 10% stuff?
And you'd be right. The logic holds up. But the examiner noted that candidates struggled with the mechanics. They would apply the allowance correctly, but then get confused about which tax rate applied to what was left.
They were mixing the buckets.
Exactly. Applying 10% to the property or 24% to the business asset. The takeaway is you have to be incredibly disciplined. You strip out the allowance from the highest rate first, but the remaining math has to respect those original silos.
A strict hierarchy. Okay, speaking of property, let's talk about a BELO. This was my favorite part because it deals with a loophole that feels like it shouldn't exist.
The deemed occupation rules. This is a massive aha moment for anyone who travels for work.
So the basic rule, private residence relief, is if you live in a house, you sell it, no tax. Simple. But Abelo is overseas. He was working elsewhere in the UK.
And normally, if you aren't living there, that part of the gain is taxable. But the tax code lets you pretend you were living there. That's deemed occupation.
Okay, let's go through the specific allowances. First, traveling overseas.
You're allowed up to 3 years of absence for any reason. Backpacking, sabbatical, whatever.
As long as you lived there before and after.
Right. Those 3 years count as tax-free. But Abela was away for 38 months.
So he went over the limit.
By 2 months. You get 36 months, the other 2 are taxable. It's a hard stop.
Okay. Then he was working elsewhere in the UK.
This is the employment rule.
Yeah.
More generous. You get up to 4 years. Abela was away for 56 months.
So again, he hits the cap. He gets 48 months tax-free. The rest is taxable.
Precisely. But then we have the safety net, the one that applies to almost everyone, the final period exemption.
How does that work?
The law says the last 9 months of ownership always count as if you were living there. Doesn't matter if the house was empty, rented out, anything. Those last 9 months are tax-free.
Why?
To give people time to sell their old house after they've moved into a new one.
But the report says candidates missed this.
They did. Because Abella was traveling overseas right at the end. He never moved back in. And usually, to get those other travel allowances, you must physically return to the property.
So because he didn't return, those allowances should fail.
Yes, but T, and this is the key, the final period exemption overrides that requirement. The last 9 months were exempt simply because they were the last 9 months. Candidates forgot to layer that final exemption on top.
That is a critical safety net. It saves the relief even if you mess up the other conditions.
Exactly. Now, Abela wasn't done. He also got involved in a corporate takeover. He owned shares in Lagoon Flick, and they were bought by River Flick,
A classic M&A deal. He got cash and new shares.
which creates a calculation nightmare. The instinct is to say, I sold my shares, I calculate the gain on everything.
But you don't.
No. The tax man says you've only realized the cash part, so you only pay tax on the cash.
So how do you work out the original cost of that cash bit?
You use the part disposal formula. It's A over A plus B. So it's cost times cash received divided by cash received plus the value of the new shares.
Seems like a simple fraction. Where did they go wrong?
The denominator, value of new shares. A lot of candidates use the par value, the 1 pound or 10p printed on the share certificate.
But that's meaningless. A share's par value can be a fraction of a cent when it trades for hundreds of dollars.
Completely meaningless.
Yeah.
You were supposed to use the market value. In this case, the River Flick shares were trading at 1 pound 65.
That's a huge difference. Using 1 pound instead of 1 pound 65 messes up the whole fraction.
It does. You end up allocating too much cost to the cash, which artificially lowers your tax bill.
Yeah.
The examiner flagged it as a major error. You always use market value.
Market value, not par value. Okay, let's move to topic 3. Timing. We've got a character named Crute. This is a story about the calendar.
Crute is a lesson in patience. He sold shares on April 10th instead of April 1st.
Okay, so in the UK, the tax year ends April 5th. So April 1st is 1 year, April 10th is the next. Did he save any tax by waiting?
In his specific case, no. The examiner pointed out that Crute was a high earner. He'd used up all his basic rate bands in both years, so the tax rate was exactly the same.
So a lot of students probably thought no difference.
And that's where they failed the expert test. It matters enormously for cash flow.
Walk us through the dates.
If he had sold on April 1st, 2024, the tax is due by January 31st, 2025. That's the deadline.
But because he waited 10 days.
Until April 10th, that sale falls into the next tax year.
Which means the deadline is?
January 31st, 2026.
Wow. So just by waiting a week and a half, he delayed the tax bill by a full year.
A full 12 months. That's basically an interest-free loan from the government. A huge financial benefit.
That is the real insight. It's not about tax reduction, it's about tax deferral. Now, Crute also had an issue with payments on account.
Ugh, yes. Where you have to pay tax in advance for next year. The tax man assumes you'll earn the same again.
But Crute's situation changed. In the next year, his income was going to be almost entirely from his job.
Which is tax at source via PYE.
So he'd be paying double. Paying on account and through PAYE.
Effectively, yes, until he gets a refund. But the examiner pointed out a claim many people miss. If your tax for next year is going to be covered at source,
You can reduce your payments on account.
you can claim to reduce them to zero.
Zero.
Without penalties. The examiner noted that candidates wasted time calculating the payments, completely missing that he could just wipe them out.
That is a huge cash flow tip. Don't pay the government in advance if you don't have to. Okay, on to Michael. Michael's trying to figure out his trading profits.
First, you have to establish if he's actually trading. You use the badges of trade. It's the test to decide if you're a business or just selling stuff on eBay.
The examiner asked for 4.
Right. Key ones are subject matter, length of ownership, so quick turnover frequency of transactions, and crucially, profit motive.
And Michael was definitely trading, but the real headache was converting his accounts from cash basis to accruals basis.
This transition is tricky. The big sticking point was his car. Under the cash basis, you just claim a simple mileage allowance, 45p a mile, keep a log, done.
Simple.
But under the accruals basis, you can't do that. You have to claim the actual expenses, fuel, insurance, and then claim capital allowances on the car's cost.
Which is way more paperwork, and you can't mix and match.
No, you have to pick a lane.
Speaking of cars, Michael tried to deduct his speeding and parking fines.
I feel like every year candidates try this. The report was very firm. Speeding fines are incurred because you broke the law.
But what if I was speeding to a crucial client meeting to close a deal?
Doesn't matter. Breaking the law is not a necessary expense of a trade. The tax man does not subsidize your lead foot. Fines are never, ever deductible.
Fair enough. What about his pension?
Another common error. Candidates often try to deduct the trader's own pension contributions as a business expense.
It feels like a cost.
It is, but it's a personal cost. You add it back to the business profit.
Yeah.
You claim the relief on your personal tax return later. The only pension costs that are business expenses are for your employees.
Right. Keep the business and the person separate. Okay, final topic. Corporate complexity with a company called Slowing Ltd. This is about group relief.
This is where percentages matter enormously. Slowing Ltd had two subsidiaries, Up Ltd and Down Ltd.
Up and down, okay.
To share trading losses, basic group relief, you need a 75% group. The parent must effectively own at least 75% of the subsidiary.
Slowing owned 80% of Up Ltd, so that qualifies.
Yes, but for Down Ltd, it was a chain. Slowing owned 80% of Up, and Up owned 80% of Down.
So you multiply them. 80% of 80%.
Which is 64%.
And 64% is less than 75%. So Slowing can't use trading losses from Down Ltd.
Correct. But wait, the report also mentioned capital losses. And this is the nuance. The definition of a group changes depending on the tax you're talking about.
You're kidding.
I wish I was. For capital gains groups, the rules are different. The effective interest you need is only just over 50%.
Oh, wow. So because Slowing had an effective interest of 64%.
That's greater than 50%. So Slowing could use the capital losses from Down Ltd, even though it couldn't use the trading losses.
That is incredibly confusing.
It is. Candidates just assumed if you're not in a group for one thing, you're not in a group for anything.
Yeah.
But the capital gains group rules are looser.
One last corporate acronym. SBA, Structures and Buildings Allowance.
This is a relatively new one, a flat 3% deduction per year on the cost of new commercial buildings.
And the track is?
The land. You buy a plot for $1 million and build an office for $1 million. You claim SBA on the construction.
But not the land.
Never on the land. Land doesn't depreciate. But candidates often just apply 3% to the total cost. You have to strip the land cost out.
And you have to prorate it, right?
Yes. If the building came into use halfway through the year, you get half the allowance. It's a slow, steady 3% per year, prorated to the day.
We have covered a lot of ground here, from 16-month accounting periods to speeding kinds.
If there's one theme, it's that tax is rarely about the big round numbers. It's about the boundaries.
The boundaries.
The boundary between April 5th and April 6th. The boundary between 74% ownership and 75%. Between par value and market value.
And the report proves that you can get the concept right.
But if you miss the specific boundary definition, you get the wrong answer.
And in the real world, the wrong answer isn't a red X. It's a check you have to write to HMRC.
Or a refund you never claimed.
So here's a thought for you to chew on. We talked about Crute and how selling his shares 10 days later shifted the payment by a full year.
A powerful cash flow tool.
So if you were to sell a major asset today, a house, a business, a crypto portfolio, do you actually know when the bill for that is due? Is it next January? The January after that? Or like in some property cases, is it actually due within 60 days?
That's the scary one. For UK residential property, you often have to file and pay within 60 days of completion. If you're waiting for January, you are already months late and racking up penalties.
The answer might change your financial planning entirely. Don't assume you know the date. Check the calendar, check the rules, and maybe learn from the mistakes in the 2025 exam so you don't have to make them yourself.
Couldn't have said it better.
Thanks for listening to The Deep Dive. We'll catch you next time.